First of all, it's important to understand that there are significant differences between the algorithms of exchange-based markets, such as stocks and commodities, and peer-to-peer, P2P markets like cryptocurrencies. The cycles in stock and commodity markets tend to operate on higher timeframes and within narrower ranges compared to P2P markets. However, the underlying mechanisms of these algorithms are essentially the same. Another crucial point is that financial markets are not inherently productive. They do not create added value. At best, they can be described as zero-sum loops, meaning the money that flows through these markets balances out overall. Therefore, it's essential to carefully consider why these markets were developed before investing in them. Now, let's examine some characteristics of market behavior that arise due to these algorithms. First, let's assume the market operates randomly. Mathematically, at any given point, there are two possible movements for the price. It can either increase or decrease. This implies that over a large number of trades, traders should have roughly a 50% win and loss rate. However, in reality, this does not happen. Statistics show that 96% of individual trades result in losses. This means that, regardless of where you enter the market, you are likely to experience drawdowns and losses from that point. This characteristic of the market underpins the provision of leverage in financial markets. There is no benevolent intention behind these markets, and none of the market owners are interested in making you rich by allowing you to trade with leverage and more than your funds. On the contrary, they have created this system because they know that mathematically you will lose. But how can they be so certain about this? The only plausible answer is that they know the correct answer, meaning they understand that no individual trader can consistently be correct, except themselves. One of the most popular and basic price patterns in markets is channel price movement. Let's examine whether these are created intentionally. In a previous discussion, we explained that market algorithms operate in time and price cycles across all time frames, leading to the creation of certain patterns that prevent traders from capturing the entire profit from movements in higher time frames. First, we'll explain the concept and then observe it in a live market. Assume the price of an asset is at a specific value today. You need to identify the market trend and determine which time frame cycle is currently in play. To achieve this, you must understand all time frames in one context. For example, you might find that the daily time frame is in a bullish trend for the next 35 days, the 4-hour time frame is bullish for the next 6 days, but the 1-hour time frame's bullish cycle will end at 3:30 tonight, initiating a price correction bin sector trend. And these trend cycles operate effectively in every lower time frame as well. This complexity explains why traders often experience drawdowns, triggering their stop losses or causing margin calls. Channel price movements occur because of these cycles and perfectly align with the intentions of market creators. If you examine price movements, you will notice that most entry points within a price channel experience drawdowns. Consider that most technical analysis methods rely on confirming price action. But when this confirmation occurs, a lower time frame cycle often ends, leading to an opposite price movement. In summary, the intricate design of these market algorithms and their cycles ensures that individual traders frequently face challenges, reinforcing the advantage held by those who understand the underlying patterns and mechanisms. Unfortunately, we cannot share our findings directly due to various considerations. However, we will provide some hints to help you protect your investments in the markets. To do this effectively, we need to redefine certain market concepts so that we share a common understanding. In our next video, we'll discuss our definitions and standards in financial markets.